Good morning, everyone. Today's lesson is all about debit and credit explanation. So I'll try to explain the debit and credit most easiest way. Uh, some of you already told me like sometimes you find it difficult to understand the debit and credit and how it is actually work on the accounting system. So I'll try to explain today debit and credit that for the AAT level 2 course that's going to be very basic if you never done accounting before, if you have no idea about the debit and credit, still that's going to be very helpful, and of course like you'll understand from very scratch. So I'll try to explain from the very beginning how actually debit and credit work. So for this course AAT, you need to have a very good understanding on the debit and credit. Without debit and credit, actually, you cannot do anything. Not only for this AAT, even on your workplace. If you don't know your debit and credit, that's going to be very, very difficult for you to carry on the bookkeeping work. The reason is all the accounting start from debit and credit, that is journals. So before journals, there is no accounting records. So accounting actually start from the journals, that is debit and credit. So we try to learn today debit and credit from the transaction. So let's have a look how actually the debit and credit work. So let's talk about uh, some numeric word or uh, some word that will help us to remember the debit and credit. This two one is very very popular for the AAT course. We call it date and click. So let's talk about date and click. This date and click will help us to calculate or identify debit and credit. Date and click. CLIC. So let me write it down. Click. CLIC. So that is date and click. So date basically will explain all about the debit. So if we talk about date, the first thing we have D for debit. Then we have E for expenses. Then A for assets. And the final one we have D, that is D for drawings. So if any of you don't know what is drawings, so drawings is the money that is withdrawn by the owner. Drawings is the money that is withdrawn by the owner of the business. So when the owner withdraw any money from the business, we call it drawings. So when debt is increased, that time it is debit. When debt is decreased, that time it is credit. For example, when my expenses increase, that is debit. If my asset is increased, that is debit. If my drawings is increased, that is also debit. On the other hand, when my expenses decrease, going down, if my asset is decreased, going down, or if my drawings is going down, that is credit for me. On the other hand, identifying the credit, we have C for credit, L for liability, we have I for income, and we have C for capital. And this is the opposite of the debt. So if click increase, then all are credit. If click decrease, then all are debit. That means if my liability goes up, if my income goes up, if my capital goes up, that time it is a credit. But for some reason, if it is going down, that is our debit. So this is the basic understanding of the debit and credit. If you remember the date and click, that will be easy for you to remember how to calculate the debit and the credit. Now let's have a look of some example, and we'll see how actually we can identify the debit and credit from the actual quotient from the transaction. So let's have a look at that. So we'll try to go back to our book and try to see from there. So we have here, let me change it. Okay, so let's move on here to this PPP book for the AAT level 2, and here they explain about the debit and credit. So you can see here they're clearly saying if our asset, if our expense, and if our drawings, that is relevant to the debit. Now in the book or in the accounting term, debit is always a represent with DR. So DR means actual is a debit. And on the other hand, we have liability, income, and capital. These three represent always the credit that represent as a CR. So CR means the credit. Normally, if we have a T account or ledger account, the left hand side is always the debit side, and the right hand side is always the credit side. So left hand side is always the debit side, and the right hand side is always our credit side. Now let's have a look actually how we can see this one on the question. Let's have a look one of the example. Okay, if we look at this example, here it's saying introduction to the double entry. Double entry means two entry. Double entry means two entry. One is debit and one is credit. The next one says, what is the double entry for each of the following? Explain each entry in the term of element of the financial statement, and the first two have been done for you. So they said we have to do all this transaction, and the first two they already done for us. This is number A and B. Now in real life, if you work in a company, you have to say this is asset, this is liability, and you have to know what is debit and credit. Now they said from the financial statement perspectives, financial statement means the profit and loss account and the statement of financial position or balance sheet. So this is the actual accounts prepared by the company and they submit to HMRC. So let's talk about the transaction. Transaction, what is transaction? Transaction is basically when we have like day-to-day activities from the business. For example, what business do? Business buy something and sell it to the customer. So business buy something and they sell it to the customer. Now, when business buy something and sell to the customer, and day-to-day life, they pay the rent, they pay the rates, they pay for the advertise, they receive from the sale of goods. All of this is a transaction, and this is a thing happen every day with a business. So this transaction we have to convert into the form of double entry that is called debit and credit. Let's have a look one of the transaction here. The first transaction we have here, sell for cash. So I'm selling something and the customer paying me cash. I'm selling something and the customer paying me cash. So what is the journal here? How I'm going to identify what is debit and what is credit from this particular transaction? So we have two things here. One is sell and we have cash. One is sell, one is cash. Now, sell is the income and cash is asset. So we have our data and click. So just write it down, data and click here, so that we can easily match with the data and click with the transaction and identify what is debit and what is credit. The first one is D for debit. You already know that. E for expenses. A for assets, and D for drawings. So if all of this going up, this is our debit. If all of this going down, that's my credit. On the other hand, we have a C for credit, L for liability, I for income, and C for capital. And when all of this going up, this is our credit. When all of this going down, that's my debit. This is opposite of our debt. Now let's have a look how actually this formula work on the transaction. So for the first transaction, we have sell for cash. So sell is a income, so sell is a credit, and cash is asset, cash is a debit. So you can see on the debit and credit section, we are saying cash is a debit because increase in asset. And of course, under the debt, we know if the asset is increasing, then this is our debit. And sell is income, and income is increasing under the click. So this is our credit. So all you need to know what is income and what is asset. If you can identify what is asset and what is income, what is expenses, our life will be very easy to identify from the transaction what is debit and what is credit. Let's have a look at the next one. The next one is saying sales on credit. Sales is income, we know it anyway. And the credit, this time sales on credit. Sales on credit means the customer is not paying immediately. Credit means customer will pay later. Credit means customer will pay you later. So if the customer said, okay, let me buy from you now, I'm going to pay you later. If the customer said that I'll pay you later, we called it sales on credit. That's not a cash sale. We called it credit sale. And when the customer said he will pay us later, so here's my asset, and I have a name for them. So I called him sales ledger control. So when my customer said, I will pay you later, I said, you are my asset. You are my asset. How? Because if the customer said, I will pay you later, that means you are my asset and you're going to pay some money in future. So if you are going to pay some money in future, so you are my asset. So if you are my asset, then you are my debit. And when the customer said, I will pay you later, we don't call them, you are my customer. In accounting terms, we have a name for them. We call them sales ledger control. Sales ledger control. So if the customer tell you, I will pay you later, then we have a name for them. We call them sales ledger control. So sales ledger control is a debit because asset is increasing because I have one more customer he going to pay to me. So that's my asset. That is debit, and sale is income anyway, so sales is a credit. The next one, purchase for cash. There is two things, purchase and cash. So when I buy something, let's say like you buy a mobile phone, you buy something. So when you buy something, then that's expense for you, isn't it? When you buy something, is always expense for you. So purchase is always expense. Purchase is always expense. Purchase is always expense, and expense is always debit. If the expenses increase, if I buy something and my money will go, so expense will be increased. More I buy, more the expense will be increased. So if I buy something, expense will be increases. So if the expense is increased, that's my debit. So purchase will be debit. Purchase is debit because expense increase. And for cash, so I'm buying something and I'm paying cash. So when I buy something, I can pay cash or I can pay credit. So credit means I'll pay you later, and cash means I'll pay you immediately. So when I buy something and pay for cash, that means money is going immediately. My asset is reducing because cash is an asset. Because cash is an asset. If I buy something, my cash balance going down immediately. So my asset is going down. If my asset is going down, so cash will be credit because asset decreasing. So that's how we have to identify what is debit and what is credit. Let's have a look at the next one. Purchase on credit. This time I'm buying something purchase, so that is expense. And expense is increasing. That's why it's a debit. And on credit, that means I'm not paying to my supplier immediately. I'm buying something, but I said I'll pay you later. So I'm creating a liability. When I said I'm buying something now and I'll pay you later, that creates a liability because I have to pay this money to them. So liability is created. So if the liability is created, so on the click, we can see L for liability. So if the liability is going up, that's our credit. So for the liability for the supplier, we have a name for them. So if I tell my supplier I'll pay you later, I have a name for them. I call them purchase ledger control. It's the opposite of sales ledger control. We called it purchase, PURCHASE, purchase ledger, LADGER, ledger control. So we call them purchase ledger control. So when I tell my supplier I'll pay you later, I'm creating the liability and I have a name for them. We call them purchase ledger control. So purchase is a debit because expense is increasing. Purchase is debit because expense increasing anyway. And purchase ledger control is a credit because liability increasing. As soon as I'm saying I'll pay you later, I'm increasing the liability. The next one is a pay electricity bill using cash. Pay electricity bill using cash. So I'm paying the electricity bill. So electricity is the expense and paying the cash. Cash is the asset. So what happens if I pay the electricity bill by cash? So cash is going, so asset is decreasing. So asset going down. If the asset is going down, so cash should be credit because under the debt is say if the asset going down, that's my credit. So if the asset is going down, that's my credit. And electricity bill is expense. Any type of bills, rent, rate, electricity bill, any type of bills is expense. So that's my expense would be increasing and that's my debit. So you would say here electricity debit because expense increasing. On the other hand, cash is a credit because asset decreasing. If I give my bill from my cash, so obviously like my cash balance will go down. The next one I have received cash from a credit customer. Remember on number 2, we make a sale, credit sale. So that time the customer said, I'll pay you later. That time the customer said, I'll pay you later. But now the customer saying, I'm going to pay you. So if my customer paid to me, he's not my asset anymore. Because until the day he paid to me, I said, you are my asset, you are my asset. And the day he paid to me, I cannot say you are my asset. So I need to make him down. The figure need to be reduced. So I would say sales ledger control was before debit. Now I'm going to make sales ledger control credit because asset is decreasing. Asset decreasing. On the other hand, he paying me cash, so cash is coming to me. So cash is a asset, so cash will be debit because asset increasing. One asset decreasing, that was sales ledger control. So the customer, I said he will pay, so he's my asset. The person, the day he paid to me, he's not my asset anymore. And on the other hand, he's paying to me cash, so money is coming, so asset is going up, so asset is a debit because cash is going up. On the other hand, the person, I said, you are my asset, so I said, from today, you are not my asset because you already paid the money. The next one we have here, pay cash to a credit supplier. So I'm paying cash to my credit supplier. If I pay money to my supplier, credit supplier, that one I had a liability. So you can see here, number 4, we said purchase on credit. So we buy something and we told my supplier, like, I'll pay you later. Now I'm paying to him. If I pay to him, my liability will go down. If I pay the money, so my liability is no more. For example, if I take a loan from the bank and if I pay the loan, my liability is finished. There is no more liability. So if I pay to my supplier, I would say, listen, the product I buy from you before, I already paid for that. So obviously that's not my liability anymore. So my liability will go down. So if my liability go down, on the click side, you can see if the liability go down, this is your debit. So it's a purchase ledger control. Before it was credit, now it will be debit because liability decreasing. On the other hand, the money is going, so cash is going if I pay cash. So cash will be credit because asset is decreasing. Asset decreasing. And the last one we have borrow money from the bank. Borrowing is always a liability. If I borrow from anyone, it's always liability from the bank. So borrowing money means it's a loan. Loan is always liability, and if the liability goes up, it's a credit. So loan is a credit. If I take a loan, it's always credit because liability increasing. Liability increasing. And if I take the loan from the bank, money will come to me. If I take any loan from anyone, not from the bank, if I took a loan from anyone, the balance of my account will go up. So money will go up on the bank. So the bank will be debit because money coming to the bank. So bank will go up, asset will go up. So the reason will be here why the bank is debit because money will come to the bank because of the loan and my bank balance go up. That means my asset will go up. Asset will increase. Now all of this transaction, the business can have more transaction. They can pay the rent, they can pay the rates, they can pay the bills, any type of things. But if you I can identify what is asset and what is liability, what is expenses, it's going to be very easy for us to using this formula dead and click and to identify very quickly what is debit and what is credit. So I hope like you have some idea now about the debit and credit. And of course, I will try to explain more about the debit and credit and how we transfer all this information to the next step. So after the debit and credit, after the journals, our next step is to prepare the ledger account that is called T account as well. So from the journals, how to move the information to ledger account, I'll try to explain this all of these things maybe the next video. So hopefully like now we have some idea how the debit and credit work, but you need some more practice anyway. So if you do practice some questions, and of course you'll be very happy with the debit and credit. Okay, so I'll try to explain on the next video about our debit and credit and how to move to the ledger account. So for now, it is like for now we can say goodbye. We'll see you next video with the ledger account and how to move all this information from here. All right, thank you for watching. Hopefully, we'll see the next video as well.